Bonds can be a valuable asset in the defensive part of the portfolio because they can give you a little bit of extra income without taking a whole heap of additional risk, provided you pick the right bonds, of course. Trying to explain every aspect of bond investing in a single video would likely be a little bit overwhelming and you guys probably get bored and click away. So what I'm going to do is I'm going to break down bond investing into 3 parts: beginner, intermediate, and advanced. This beginner guide is going to give you the basics of what a bond is. I'm going to explain exactly how bonds work, I'm going to explain where they sit in the portfolio, and I'm going to give you an idea as to how you can gain exposure to bonds. So let's get cracking. Hello guys, Brad here from The Guided Investor. Today we're covering off a topic that was requested from a subscriber, so thank you very much for that request, and I hope that today's video can answer some of your questions. Now, like I said, we're going to keep it as the beginner's guide to bond investing, but I will put out an additional 2 videos on the more advanced features of bonds. So hopefully I answer some of your questions in this video, and if not, we can cover off the rest in the next videos. So first of all, let's kick things off with an explanation of what a bond actually is. A bond is essentially a loan. So when you buy a bond, you're basically acting like a lender, or more accurately put, you're a debt holder. The person who issues the bond, it's normally a company or a government, they are the borrower. They're the ones that have created the bond. Like most lender-borrower relationships, there are 2 key aspects that we need to look at. We need to look at the interest that's paid from the borrower to the lender as a thank you for giving me some money, and we need to look at when the loan is going to be repaid. In the bond market, interest is paid to the lender, and in this case, the lender is the investor. The interest is actually called a coupon payment, and it's normally paid semi-annually. The size of the coupon payment is always tied to the bond's initial issuance value, which is known as its par value. So the interest you get on the bond is quoted as a percentage of the par. Now this is known as the coupon rate. Put mathematically, the coupon rate is the annual coupon payments divided by the bond's par value. Generally, the coupon payment is going to be higher or lower depending on who you lend the money to. So you normally have 2 options. You can either lend money to the government or you can lend money to corporates. Now, if you buy a government bond, the chances of them, particularly an Australian government bond, the chances of them defaulting on that bond are very, very, very low. Whereas if you buy a corporate bond, let's say you buy a bond from a large bank, then there's still a very low chance they're going to default on that bond, but the chance is slightly higher than the government, so therefore you expect a slightly higher rate. The other key factor of bonds is its maturity date, and the maturity date is the date at which the borrower will buy back the bond from you at its par value. And now there is a secondary market for bonds, so you don't have to own them for the full period. And the secondary market means that the price of the bond can fluctuate, and therefore that's going to impact the running yield. In order to properly understand how the secondary market impacts the yield that you get from a bond, you need to understand how the running yield is calculated. And it's pretty simple. All you do is you get the annual coupon payments from the bond and you divide it by the bond's market price. If interest rates rise, the market value of a bond will fall, as the interest rate that investors can get on their cash has just increased. And when we have a decrease in the market value of a bond, this is going to increase the running yield. If interest rates fall, the market value of a bond will rise as the amount that investors can get on their cash has just reduced. And this in turn is going to increase the value of the bond and therefore decrease the running yield. As the bond gets closer to its maturity date, the market value of the bond is going to trade closer and closer and closer to its par value, despite the interest rate. And this is because when you hit the maturity date, the bond will be repaid at its par value. When assessing the risk-return trade-off of an investment, we always consider where it sits on the risk ladder. Now, the risk ladder basically compares the risk or the potential volatility of that asset with the potential return of that asset. So when there's more risk and there's more volatility, we're going to expect a better return. This ladder can vary slightly depending on which country you live in and who you ask, but my version of the risk ladder looks like this. At the bottom of the ladder, we have, with the lowest risk and the lowest potential return, cash and term deposits. If you put $100,000 in a term deposit, you know that in 1, 2, 10 years, that 100,000 is still going to be sitting there. Even if the bank goes bust, the federal government offers deposit guarantees of up to 250,000 to eligible banks, building societies and credit unions, so cash and term deposits earn their spot at the bottom of the risk ladder. Coming in after cash and term deposits are government and corporate bonds. Government bonds tend to be a little more stable than corporate bonds because you're lending money to a government as opposed to a company, but both sit low on the risk ladder. These are the asset classes that I would consider defensive assets. Once we start moving up from here into infrastructure, property, shares, and private equity, we're in the growth asset territory. These asset classes have a better chance of potential return, but come with more volatility. The capital value of your asset is going to fluctuate. Now remember, this is my version of the risk ladder. It doesn't cover every single asset class. And some people would consider infrastructure and properties as defensive assets, whereas I really don't. This is what I feel most comfortable with. Going back to the bonds, as you can see from the risk ladder, both government and corporate bonds are a relatively low risk, low return asset class. You can expect a little variation in their market price due to the secondary market for these bonds, but if you buy quality bonds with little risk of default, then you know that by holding the bond to maturity, you can get back the par value of your bond. Attributing to the defensive nature of bonds is where they sit in the priority of liquidation relative to shares. So if a company goes into administration or goes bust, then basically there is a liquidation process and there's a hierarchy that they follow in order to determine who gets paid their money first. In this hierarchy, liquidated costs are paid first, followed by secure creditors, then employee benefits and entitlements, then unsecured creditors, and finally shareholders if there's anything left over. Bonds sit with unsecured creditors. As a corporate bondholder, if a company goes into liquidation, then you're going to get paid out before the shareholders. Put more simply, if a company goes bust, then there's more chance of you recouping some or all of the value of the bond than there is as a shareholder. However, as with all asset classes, bonds do come with risks, and we need to have a look at these risks. So let's do that now. As we already discussed, there is a secondary market for bonds. This secondary market causes bonds to trade at a premium or a discount to the bond's par value. As a result, there's going to be fluctuations in the capital value of your investment. This fluctuation is normally less significant than shares. Bonds are sensitive to interest rate changes. A change in interest rates will impact the market value of your bond. This can be mitigated to an extent by floating rate bonds, which we'll discuss in the intermediate guide to bond investing. The purchasing power of a bond's coupon payments are going to be impacted by inflation, particularly in bonds with a long maturity date. If inflation is high, your purchasing power reduces, and this will likely lead to higher interest rates, which is all negative for bond prices. If you buy an individual bond, you may be subject to liquidity risk. That is, you cannot find a buyer for your bond in the secondary market. Liquidity risk can be overcome to an extent by using bond funds, as I'll discuss later. When you buy bonds, you run the risk that the bond issuer is unable to make interest or principal obligations and therefore default. This is known as credit risk. You should always look to buy bonds in governments and companies which have strong balance sheets and good cash flow. Despite these risks, for me, bonds still sit in the defensive part of the portfolio. Defensive assets are those ones that give you that really good sleep well at night factor because you know there's little chance of losing your capital, but you don't get a great return on your money. So with bonds, you're normally likely to get a slightly better rate than you could get in a term deposit. With all asset classes I invest in, I like to get a diversified exposure, and it's no different with bonds. So therefore, when investing in bonds, I would suggest you buy a bond fund, either active or passively managed. This is going to give you a very broad exposure to a number of different bonds from a single holding. There are many ways that you can buy bond funds, including managed funds, exchange traded funds or ETFs, listed investment companies or LICs, and M funds. Now, I tend to use the ETFs and the LICs the most. In order to buy a bond ETF or LIC, you simply buy it on the Australian Stock Exchange like you would any other shareholding. All you do is type in the ticker code, have a stockbroker account, hit the buy button, and you're done. In the intermediate guide to bond investing, I'm going to delve a little bit deeper into ETFs versus LICs for bonds, outline the real difference between that active and passive management, and talk a little bit more about my preference. When you buy bonds, they're a great asset class to serve as a store of wealth, which is going to give you a slightly better income return than you could get from cash. Sure, there's some risks to bonds, but I think you can mitigate those risks, and therefore I feel comfortable including them in the defensive part of my portfolios. For younger people with a long time horizon, then bonds are fine in the short term as they can act as a store of wealth when you think stock prices are overvalued. But I wouldn't look to hold a large chunk in bonds for a long period of time, simply because over time, equities are much more likely to outperform them. But that's it for me, guys. Thanks a lot for watching. Please leave a like if you learned something new today, and I'll see you guys in the next chapter of bond investing.